Hello and welcome to Business Incorporated, coming to you live from Channel's television headquarters in Lagos. I am Bolaji Akinwale. Coming up, President Muhammadu Buhari is on his way to Germany. And Tanzania's Swalla Oil is set to raise $120 million corporate bonds. Plus, Namibia's consumer inflation up at 6.9% in the month of September. We'll begin with Nigeria's president's visit to Germany. President Muhammadu Buhari is on his way to Germany on an official visit, which will be from October 13 to 15. In Berlin, President Buhari will confer with Federal Chancellor Angela Merkel on issues of shared interest between Nigeria and Germany, including further cooperation on security, the humanitarian situation of internally displaced persons, and rehabilitation of the Northeast, as well as trade and economic relations between both countries. Thereafter, the president will meet with Federal President of Germany, Joachim Gauck, in furtherance of the administration's objective to attract more foreign investments and create economic opportunities in the country. The president will participate in a business forum in Berlin with leading German companies already active in Nigeria and other prospective investors. Before returning to Abuja, the president is expected to meet with representatives of the Nigerian community in Germany. And European stocks were lower in morning trade after minutes from the U.S. Federal Reserve's September meeting raised expectations of a December interest rate hike, and weak China trade data weighed on investor sentiment. Let's bring in Conrad Busen, who is DWTV financial correspondent, is live to me from the Frankfurt Stock Exchange. Conrad, welcome to the program.
Hi.
It's good to have you. Now, first of all, Nigeria's president, Muhammadu Buhari, is on his way to Germany, like I mentioned earlier on, and he is expected to meet with Chancellor Angela Merkel and other officials of the German government, as well as the business community. On the part of investors, what are the expectations?
Well, Bulaji, I think we have to distinguish between the short-term and the long-term hopes and expectations of investors when it comes to Nigeria. Among some of the short-term topics that business people will address when they meet President Buhari are, for example, the rumors about the Nigerian banking sector, the problems of non-performing loans, the low currency reserves of the CBN, the Central Bank of Nigeria, and stuff like that. But on the other hand, of course, people in the business world here will have to say quite a few friendly and positive things to the president when he comes here. For example, the way that President Buhari has been coping with Boko Haram and the militancy in the Niger Delta, that's seen rather positively here. And of course, investors also see what Buhari has done in terms of transformation of the economy in Nigeria from a more public sector-driven to a more private sector-driven economy. That's positive. And people here in Germany and Europe in general are aware that Nigeria has to spend billions of euros, trillions of naira probably, in infrastructure in the future. And I'm sure that there are a lot of companies here that would like to try to cooperate with your authorities in Nigeria and with your investment decision makers when it comes to doing business here.
Now, it seems that the chicken has come home to roost. The Federal Reserve, at least the U.S. Federal Reserve, has indicated plans to raise interest rate. Now, this seems not to go down well with investors.
No, it's had an immediate negative effect on equity prices in Asia, also here in Europe, because, of course, the expectations that the Fed is more likely to increase interest rates in December puts a damper on hopes that equity prices, especially in the U.S., might rise more to the end of the year. But I have to say, on the other side, there's also something positive about it, because an interest rate hike in the U.S. in December would mean that the U.S. economy remains on track. It would also mean probably that we would have Hillary Clinton as a president of the United States in December and not Donald Trump. Most people I talk to here in the financial world of Frankfurt are convinced that if he was elected, it would uneasily shake the market, it would cause lots of uncertainty, and it would probably make it unlikely that there's an interest rate hike in December.
Now let's talk about the commodities market, Conrad, before I let you go. The stocks came under pressure owing to a number of factors. First, investor sentiment was dampened by a fall in oil prices after OPEC reported that production rose in the month of September to its highest level in 8 years, despite the oil cartel potentially planning to cut output. Do you think this will be short-lived?
Well, Bolaji, I think we will see a more sustainable and lasting increase of the oil price only if demand picks up more and or if the oil-producing countries, and of course I'm mostly talking about Saudi Arabia, Iran, Russia here, if they not only say that they might agree on production cuts, but if they actually do something about it, since that OPEC meeting in Algiers in September, all we've seen basically on the oil market was verbal intervention. OPEC leaders, Russian leaders trying to talk the oil price up. But they haven't really done anything. The recent OPEC output shows this. And if OPEC and if Russia really want this to be more sustainable, they have to walk the talk. They have to really practice what they preach, cut production of oil, and that would likely have the oil price increase a bit more sustainably.
All right, thank you so much, Conrad Busen, DWTV financial correspondent, reporting from Frankfurt. Still on the markets, this time in Asia, where the numbers were mixed on Thursday following soft Chinese trade data. Mainland Chinese markets shrugged off figures showing steeper than expected declines in China's dollar-denominated exports in September and an unexpected drop in imports. The Shanghai Composite was up 0.09%, while the Shenzhen Composite gained 0.2%. In Hong Kong, the Hang Seng remained under pressure and was down 1.27%. The Bank of Korea held interest rates steady at 1.25% for the fourth consecutive month on concerns about rising household debts. In Australia, the ASX 200 closed down 0.7% at 5,435.5, weighed by weaknesses in its energy sub-index, which fell 1.9%. And Swallow Oil and Gas PLC, the first oil and gas company listed in the Dar es Salaam Stock Exchange, with a significant local ownership, as engaged exotic partners to place corporate bonds of up to $120 million in order to finance a material transaction. Now, Andrew Moorfield is the head of natural resources at Exotic Partners, and it joins me on the program to put more perspectives to this corporate bond raising. Andrew, good afternoon and welcome to the program.
Good afternoon, thank you.
Now, with market sentiment mixed, especially with oil prices around $52, how do you think the bonds will be priced?
Well, I would not actually get all the fixed. It's more favorable. Last 18 months, producers have the opportunity to reduce costs, drive through significant cost reductions, and I think market sentiment is now moving a little bit more towards being risk on, and most of the negative news is priced into the bonds already. So as a result, the fact is we think it's relatively favorable market conditions. There's also been no meaningful debt issuance for the past 18 months, and nothing from Tanzania. So as a result, we've got no comparables to look at in terms of pricing. But once we've firmed up the structure and we do a market sounding, then we'll get an idea of where pricing will be. At the moment, it's a little bit too early to speculate, but our view is the fact is the market sentiment is shifting gradually towards being more positive towards the sector.
How much do you think will be realized from this sale?
Well, the targeted number is 120 million. Considerable thought went into actually finessing that number. We at Exotics are actually in the market, albeit for a Far East Asian oil and gas deal at the moment, which is of a similar size. And as a result, we've got a degree of confidence that 120 million is actually very much a reasonable number based upon our current transaction. So the target is 120 million. That's what the company has asked us to achieve, and we're confident that we can raise that.
What about the yield? Because investors are also interested on the returns.
Absolutely, and unfortunately, there are very few comparables out there. There's been a limited number of transactions done in the market. Nothing, as I said, from Tanzania. So as a result, there really are no pricing comparables that we can use as a benchmark. We've spoken to a number of emerging market investors. They've given us their price expectations. We feel that the price expectations can also be matched by that of the issuer, Swala. Again, it's a little bit too early to give an idea of where pricing guidance will come out, but our ambition is to price this deal as tightly as possible, both for Swala, but also to create a benchmark for the first energy bond deal done out of Africa since the oil price decline of the last 18 months.
Now, do you think this will affect the company's plans to expand its operations into other African countries?
Well, I think there's two things. First of all, it clearly is a considerable amount of money for Swala, and clearly the investors actually have to buy the story of where the funds will be directed. Tanzania itself, from the exotics view, is actually one of the stronger economies on the East African coast. And particularly the fact is infrastructure and energy is growing in Tanzania. So there may be the opportunity just to grow within Tanzania itself rather than looking at neighbouring regions. Now, clearly it's a decision for the Swala board. We've got great confidence in the management. But we think the opportunities within Tanzania as an exotics house is the fact that Tanzania offers considerable opportunity.
All right, thank you so much, Andrew Moorfield, Head of Natural Resources at Exotics Partners.